These pictures going by a little bit while we wait for everyone to come in. Okay, I'm going to start the webinar. Let's see here. All right. Hello, everyone. Giving everyone a few minutes while we join here and kind of see some of our pictures of our current assets. So it's good to see everyone. Let's give everyone a minute. All right, I'm excited. Go through a nice asset, another opportunity here. Welcome all. I'm going to give everyone just a couple more minutes. There's always somebody late here and there, and I've got a few pictures of the asset that we're talking about today. And if I can, let's see, to make sure that I can see in everyone. Let's see. Just going to put a quick text. Hello all. If you do have any questions, you can put them in a Q&A. We'll try to leave the questions for the end and hopefully answer the majority of them through the process. And look forward to going through this asset with everyone. Okay, I think I am recording. I'll send this out as well for everyone. So everyone that's attending, anybody that registered, you'll have this here, and I look forward to going through this. So let's get started in respect of your time, those that showed up on time. My name is Abel Pacheco. Good to have everyone. I'm the president and principal of Five Talents Capital. We are talking about this asset that you see some pictures going through, 301 Greenville, and our formal offer will be done via a private placement memorandum. Can you see full screen now, our slide deck, Jeremy?
There we go, looking good.
All right, good deal. So we're going to cover 301 Greenville, and our goals for this webinar is a few things. We're going to introduce our new fixed income 12% asset class. We are going to give you some real-time updates, as this is a deal that we currently own, which is very unique and amazing for our opportunity that we have. We'll cover next steps to invest, of course, if anybody's interested in moving forward. And then, we'll save some time for Q&A at the very end. Short disclaimer, you can read all this. And what I mean short, you get it. The lawyers have this in here. I would say as a disclaimer, this is not the formal offering. This is a webinar presentation for our investment opportunity. The formal offering will be done via private placement memorandum, legal docs, and that's done there. And obviously past does not predict future, as well as, a bunch of assumptions and forward-looking statements. So I'll let you read through that at your time. But first, to introduce ourselves and the leadership team for this opportunity. Again, as I said, my name is Abel Pacheco. I'm the president and principal of Five Talents Capital. So we're a San Antonio-based equity real estate firm, and we buy good-looking assets. We give everyone else the opportunity, friends, family, other accredited investors in this case, an opportunity to invest alongside with us, invest with us in our pursuit for great real estate that has good depreciation, that provides good returns, that our limited partner passive investors don't have to manage themselves, right? So we're invested in about 1,500 doors, roughly speaking, of multifamily, mainly around South Texas. I'm San Antonio based is where I'm at today. We invest in McAllen, Texas, Dallas, Texas, Austin, Texas. We're always looking for other assets in San Antonio, Texas, but a lot of South Texas assets and a few new developments. We've got a build to rent 98 units from the ground up. We're on first 9 units built, and we've got a land entitlement deal for about 156 units. as well. So a little bit of that, but primarily, multifamily is our core. And I have a couple of our other partners. So I'm co-general partner. We work alongside a few others. Um, Jessica and Ruben are my partners as well. Essentially, there's a lot of hooks and ties to us. If anybody knows Rackspace in San Antonio, it's a couple $1 billion firm. I worked there for 10 plus years. Ruben worked there for 12, 13 plus years. Maybe I'm shorting Ruben. And Jessica's husband also worked there for a number of years. So we've been engaged in tech startup for years. We had a literal tech unicorn that we all were a part of. We've all been to battle together since 2006-ish. And so we just pointed our targets at multifamily and commercial real estate and have had some success since then. So Jessica, Ruben, successful in their own positions as well. And they have a lot of doors themselves as well. Our extended team, which I'm going to let Mr. Jeremy Cisneros introduce his team as well. So you have the Symphony Group. So we have Jeremy Cisneros, he's representing. And Jeremy, let me let you introduce you and your team.
Yeah, thanks, Abel. Excited to be here. So my role at Symphony Capital as one of the principals is the head of acquisitions, director of acquisitions, really just looking at new deals, sourcing new opportunities in the Texas markets that we really enjoy. Just to give you a background on us, our current assets under management sits at roughly 1,000 units, $150 million plus, give or take, of assets there. Again, we love the Texas market. This is our third rodeo or fourth rodeo in Texas, and we're just looking to continue to expand the portfolio as well. I'll briefly introduce the rest of the team in case there are future questions there. Ellis Hammond is head of the equity department, raising capital. Keith Meyer is our director of operational excellence over here. Overseeing these properties takes a lot of work, and that's where Bradley Kirschbaum comes in, director of asset management. So we've been acquiring through acquisition mode. It's been a little quieter lately, so a lot of time has been spent on this particular deal, just making sure we're increasing our NOI and optimization across the whole portfolio. That's what's the name of the game right now.
Yeah, a little slow indeed. This is our this was our last acquisition in September of 2022. This 200 unit property, it was originally under contract in April. And originally a $47 million asset under contract, got retraded a little bit. We asked for a little bit of a price reduction, 45, and then at the end it was like we needed a little extra to close, so we ended up getting the asset at about $43 million. So we were happy to find it, and it is an off-market asset essentially. Before we acquired it, and the team was looking for, I think I have a little bit of a lag. Yeah, the team was looking for a good asset in Dallas area. The broker showed us another deal, our team, and essentially it was, not, we were passing on that asset, but is there an opportunity for us to keep moving forward on something else? The broker presented an off-market deal, and we were under contract. And then last year was a crazy time, so which I'll break into it a little bit on this, but essentially Symphony has a nice blueprint for success. We agreed, and so we've been partnering with them on multiple assets, targeting 20-year markets, high growth, business friendly markets across the US. We want to, invest in opportunities that we can provide workforce housing for those that need good quality, safe, comfortable, quality living housing. And we work to raise capital, partner alongside other individuals, other team members, and we want to make sure that our money is always growing. So that's the goal, right? So that's how we've had some success thus far, and want to continue on that path. And just the execution is high, and we want to communicate, ongoing through the deal. And so that's a little bit about our opportunity. So we'll give you an executive summary here. Again, I mentioned, so this asset was purchased in September 22. And it was a $43 million deal. So we bit off a big bite. It was originally intended to have about a $10 million preferred equity check. And if anybody's in the commercial real estate world, you kind of know, and looking at last year, everything kind of froze up. Everything was much harder. It was much harder to close a deal. And the preferred equity checks kind of went away as well. So everyone said, yeah, we're in. Multiple verbals around February, March, and then April time kind of goes away. So as opposed to going up about it that way, we just decided to try to raise $20 million ourselves. And so what we did was we raised $15 million of the 20. Came up a little short. We asked for multiple extensions, and so essentially we closed the deal. Our general partnership team was able to fund the remaining $5 million. And so we had the full $20 million to close, and we kind of made it an executive decision. Let us go back through the opportunity. Do we go back and put preferred equity because the deal was lined up, everything was ready to go, or and lose control, a little bit of control once you go preferred equity, if anybody understands that part of it? We wanted to maintain control, and so we thought we would offer the $5 million that was funded back to our existing investors and open it up back to the market. So as opposed to losing control, we wanted to maintain it, and that's what this is. So we were waiting for the right time. We didn't want to go too early, didn't want to go too late, and so I think this is the perfect time for us to backfill the original preferred equity. We're not raising additional capital. It's the original $20 million in equity. So I'm going to give you a little bit of the deal highlights so that everyone can see. So this deal currently, I guess the beauty of it is not an assumption or a projection 9 months into it. It's what's actually happening. So today it's a 90% occupied value add multifamily deal. It's in one of the best submarkets of North Dallas, Allen, Texas. It's got an amazing median income, amazing average house pricing. If anybody's on their, on your computers right now, Google the Lowry Freshman Center or the Allen High School football stadium. That's all you have to put in there. They've got a $70 million stadium across the street from our apartment complex. It is one of the single largest single high school football stadiums in the country. It is an amazing submarket and it's irreplaceable location and asset. We'll talk about the part from the municipality because you can't build like this any longer. And that's part of it. We already own the asset. We're controlling it. Symphony Capital is really doing a great job asset managing it. I am a managing member, or one of the 3 managing members on the deal. So Five Talents is there as a guarantor and a deal sponsor, and participate throughout the process. But Symphony does really a great job of really taking the bull by the horns and making sure we get to eliminate a lot of our risk from the property because we are proving the value add business model today. We've got a 40% rent growth on newly renovated units, and I'll give you some of the other details shortly. So we're excited for that. And let me go through. Some of my slides have a little bit of a lag, so you have to forgive me. Essentially, this is a new share class that we're offering. It was the original that was already lined up in our legal documents because we were going to take preferred equity. This is our Class D that we're offering. And the Class A was the original for limited partners. The Class B, of course, is ours. The C was anything above 100K has a special 80-20 instead of a 70-30 kicker. If anybody's interested in those, we could talk about it later. But really, the purpose of this is this has a $50,000 minimum. The previous offer had a 100K minimum. So this was a perfect opportunity for us to say, look, some people want to put 50K in. You want to have a different return than just the high risk, higher reward. This is a reduced risk. That's why it's a fixed 12% return. And essentially what we're doing is we're paying 6% dividends. That'll be a quarterly payout. They start pretty much immediately. Funds that are in by the end of June start paying out August 1, quarterly 6%, and then 6%. The remaining is at exit or refinance of the property. It's a shorter term deal because we've already had it almost a year. This, we imagine, will go from 1 to 3 years conservatively exiting, out. The original deal was a 3 to 5 year deal. So our plan was always to exit early, and that's kind of the mindset here. So 12% preferred return, fixed. There's no upside, but there's 6% paid out through cash flow and 6% at the remaining. Again, this is a 506c offering. So if anybody's here, not an accredited investor, happy to have you, but it's only for accredited investors. So the property overview, great looking asset, 80s build. It is, beautiful swimming pool, beautiful, front office. The front office looks a little different than 80s build, as you can see. It is actually a 2010-ish, I think, brand new office, if not 20, somewhere in that area. So it is modern, it is new. It was right up front and, makes the whole property look really modern. So that's a little bit about the asset, and you can kind of see that. And I showed some pictures on our website. I'll show them again at the end. So when we think about a 20-year location, this is it, right? Invest in the spots that will appreciate over time. We've got a little bit of turmoil with interest rates and things that are happening, but if you can invest in real estate with good, solid mechanics, this is what we want. We want a good school district. We want good median income. We want to be where everyone wants their children to go, but maybe can't afford. They're willing to spend a little bit more on rents, premium rents, live in that beautiful area. We continue to grow. When I say we, Dallas, Fort Worth, I mean, go Google any of the top, growth cities in the US, and the population growth keeps coming. So I won't take a lot of time to kind of go through that. You can check it out. I would Google Allen the city of Allen, though. Check that out because you'll really see. And then if you put in Allen High School, you'll kind of see the main mechanics of the population, the growth, the wealth, and the affluence that are in the market. And then where our apartment complex sits right in there. So we're right down the street, Topgolf, Cabela's, Whole Foods, this really nice shopping center, just about 5-10 minutes away. And so that's kind of what we're investing in. So we like the asset, we like everything about it, and the market is there. So let me make sure I don't skip a slide as I'm going through this. Okay. You can read through the amenities. You can look through our website that we have. There's a couple of swimming pools, really nice modern covers. It looks great. Tennis courts right now. Thoughts of making a pickleball. Man, pickleball's on fire. But we really have a lot of all the amenities that everybody wants right now. The brand new Class A leasing office that I kind of mentioned. So you can see those. And these are some examples of our current renovated units. They are really coming out really nice, in our opportunity. So this is the, when we say extremely limited supply, the main reason is the city of Allen has passed a moratorium. So you can't build garden style multifamily anymore in the city. So we have how many acres the property sits on, Jeremy?
Oh, yeah. It's roughly almost 13 acres. So a lot of green area, a lot of parking, nice big dog park. It's one of the rare items you can find anymore in Allen.
So 13 acres, it looks like you're walking through like a park system. It's really nice. It's gorgeous. And, when we say we're across the street from the high school, and actually in this picture, you can see the high school behind us, and, that area is irreplaceable. So we have that. Oh, there's our 12.7 acre sites. And, it's one of those gorgeous assets where people just say, this is really comfortable. It doesn't feel like an apartment complex, feels like living in a beautiful spot, beautiful area. And, so this is kind of what we're getting after. While this lag comes in, the proof points that we wanted to show on the asset are really a lot of our current interior renovation. As soon as this slide rolls. Okay, here we go. So we've been proving, I think I passed one. 21, nope, that was it. I'm missing. Okay, here we go. So we've been proving the model today. The original plan was take 58 units, renovate them. Why? And push up the rents, obviously. Why only 58? The previous owner had put in about $5+ million of renovation. It really, when we purchased it, it looked like my after of most of the deals that I bought, before and after. And it really looked like the after. $5 million will do that. A lot of the CapEx, the exterior was completely done. A lot of the units were completely done as well. The majority of them. The difference here was there was a lot of below market units and a lot of loss to lease burn off. And that was the original mindset was, look, let's just raise the rents, minimize our CapEx budget. The previous owner had purchased them. And so how do we turn 58 units, put in, an average of $20,000 per unit and make a really nice premium product, which you can see the rent premium versus in-place classic. Even at that mindset where we're getting 354 an increase on one bedroom, 620 increase on the two bedroom, two bath, the average was 556 of rental premium across all of the units that we were going to renovate. So what the beautiful part is owning the asset, we've turned 26 of them so far, and I'll go through the mechanics. We're actually hitting these numbers. And in fact, we're hitting an actual reduced renovation cost. So instead of spending 18K, we're spending 14K for the one bedrooms. Instead of spending 24 for the two bedrooms, we're getting down to 20. So our average per unit dropped about 4K. We've done 26. We've got 32 remaining, and there's 7 that are in flight right now. So on that mindset, it's okay, that was the plan. Well, how are they performing? Essentially, our average rents are increasing every single unit of what we wanted to attain here. So we're getting about 18% from our closing. Sorry, 18% of increased rental is average across. Call it organic rents. It's probably the easiest way to say it. 18% organically. Okay, so that's the first part. Second is since closing, we've been able to increase the average rents by about $220. That's the 18%. If we just took that number alone and said, hey, we're not going to renovate, let's just increase them all. If we continued on that average, which we're getting that higher at a 5 cap, that 528K of extra income, 220 times 200 times 12, NOI 528 divided by 5.5 as a cap rate, that is a $10.5 million future valuation. But really, we're trying to capture the extra 375 gap of those 38 unrenovated units. And that alone would be another 170K of NOI or $3.4 million valuation at a 5 cap. And then there's loss to lease that you could spin it another way and say, hey, look, what if I just got the loss to lease, the $87 per unit across 162? That's an extra $3 million of value. So essentially, these points are what we're hitting. And we are offering, so I guess even before that, before I get to the offer, that was the original game plan. That was the original path for $20 million of equity. We hit 15. We put in 5 of our own. We believe in the deal. We wanted to make sure it closed. We want to make sure we was going to buy it. And so essentially now, on top of that, we're saying, hey, this is not new equity that's being diluted in the deal. It's the original backfill of the 5 million that we put in. We're offering as a preferred. So the question is really, how are we going to make sure that we can return 12% on a $5 million chunk? And so the way we're doing is we're paying 6% of the 12 in cash flow. That's the current quarterly distribution. The other 6%, we projected about $1 million of additional equity on the deal. How do I eke out an extra $1 million to pay for that extra 6%? And we believe we can do that. We're performing, we're hitting our numbers. And so essentially that's it. It's a very, and if anybody knows preferred equity, and for those investors, some of our investors are on the, might be seeing this and you're on it too, because I know we've had other investors decide they wanted the upside originally, and then they came on board for the fixed income model as well. So if you're here, it is the same. The preferred equity gets treated as a payout first before the Class A LP investors. So that's why it's a reduced risk. That's why it's also fixed. There is no upside. I had some other investors ask me if they could put in some more money on the upside piece, and yes, you can still do that. But we think this is a good offer for the current time. So just hitting our existing metrics, and then how do we hit this 12%? That's it. That's the main model. And so we're still going to hit the units. We're still going to renovate and get after it. But that is the game plan. So let me show you some of the renovation updates, and you can kind of see these as we go through it. Let me make sure I don't skip a slide on this delay. Okay, cool. We've already proven the results on 20 plus units. We've been attaining 40+% rent growth on the newly renovated units. We're hitting 20% on the previously renovated units. So what this means is you have the $5 million of investment that the previous owner put in before we bought it. They're really nice as is. Those are getting 20%. So we haven't touched them, but they're nice. Those are getting 20% rent bumps as well. So we're getting 40% on the money we spent, 20% on the money that the previous owner spent. And, these are just, they're really doing well in the market. The renewals without anything, we're getting 10% rent bumps for existing tenants. And, all of those things are really performing. We've got the extra, the next phase of these unrenovated units. We've already begun those. Like I said, 7 underway. We're going to complete the rest. And then we're going to capture that extra 375 premium on top of everything else. So, that's the game plan, right? Let me make sure I don't skip a slide and go to our next one. Here we go. It's been a while since I've used tech. We haven't had a deal in a while. And then in addition, it's like, man, this my slide deck does not want to move with me.
At least we got a pretty photo here, a nice rehab.
At least you got a pretty one here. What's wrong with this? Hold on, I'm gonna try one more time because here we go. Now it's moving.
Yeah, you got it. Cool. I was gonna touch on your point before.
Yeah, feel free, man. Anything you want to jump into.
I take my due diligence seriously. I a few months ago, I was actually living on site for a couple of weeks. I don't know if you knew that, but making sure that we were, heavily involved with our, property management company just to get a feel of it. And like you said, it's sprawling. There's a ton of really strong neighboring retail, and Dallas is kind of known as like the headquarter of headquarters. There's so many large Fortune 500 companies. You can see that's kind of what impacts that median household income of $110,000 per year. It's just really strong fundamentals that really attracted us to this overall, and why we're spending the money to finish out the rehab. It's already a proven business model.
Yeah, I love it. Now my bullets are coming up slowly. I can see them. So essentially on this, you have the other performance updates. These are all the, kind of same points to Jeremy's, the underwriting, right? 45% reduction in loss to lease today. So the last 9 to 10 months, 100% reduction in bad debt. April, May, there was no bad debt, 64% improvement in other income. So this is coming from washer dryer, some extra fees. There's 100 carports. The previous owner, they're really nice carports too. They just didn't collect any other income. And then they were doing valet living for trash, and they weren't collecting other income in that area. So those are kind of like easy for us. 30% reduction in insurance premium. Man, God bless everyone that's in Houston. I have a deal in McAllen. It's deemed a coastal area. You're like, son of a gun. Theirs are going up by 50 or 60, 70%. Some of them are doubling. Ours went down 30%, which we're fortunate to have. So we'll take that. And, the deal has been performing pretty well for us. And we were happy that we decided to kind of double down and put in the extra, few million to close, right? So now I'm at another gap where my slide deck doesn't want to come forward. So anyways, we'll go through that. Okay, so here we have an investment summary. The point of everything, right, is like, how does my money behave? If I'm going to put in 50K, then how am I going to make my money back? So this investor pro forma is essentially very simple. It was designed that way. the LP class, we'll call them class D, so preferred equity, we mentioned fixed income. It's an example, 100K investment. So I see a negative number. You put in 100K, then by the end of year one, we would have paid 6% quarterly distributions. It would total up to 6K back in your pocket year one, year two, another 6K. And then if we're projecting a 1 to 3 year hold, we cut it in half, right in the middle. We said, let's say after 2 years, if we exit or refinance, then that's where the remaining 6% year one, 6% year two, which is always accruing, that would total up to 12K. So you'd get your seed capital back, the 100K that was always your seed, and at year two would total to 118. So it is a fixed, reduced risk, reduced return on purpose. Let's make it, nice and provide some kind of cash flow, which is a lot of our investors have been asking me, can you produce cash flow? Can you produce cash flow? And some of our deals, it's the cash flow squeezed, and this is intentional for that to provide it for investors today. So that's what we have. And essentially totals up to 12, 6 current, 6 at exit. Then we have, let me go through. I would say one of the biggest risks that I've probably heard about nonstop, and I'm experiencing on some of our other assets. Like it's just, unavoidable. It's the interest rates. It's what's going to happen. It's how's this deal going to perform. And, for us, essentially, this is a 5-year interest only, term. So interest only bridge, variable rate, that debt goes up and down. And you're like, man, how did we even, manage to close this deal? Well, we purchased a $1 million 2% strike 2-year rate cap. So the way you avoid the volatility is you pay money. You buy a lot of insurance. And that's essentially what it is. A $1 million rate cap that was acquired. It caps our rate at a ceiling. So as opposed to the volatility that's happening, even on some other deals, it's like, hey, the volatility is there. This is a fixed 6% cap that we put on it. So we've got a straight line debt service. We've got some debt, some payments that are coming back to us, and just, to ensure that. So that worked out really well. Additionally, when we closed, the lender required almost $500,000 of interest reserve that currently sits with the lender for interest reserve to actually have it just in case. We have the flexibility to refinance after 18 months, which again, short-term deal. That was the goal. So March 2024, that's the option. And there's no extension fees for all the 5 years. So if we were going to, keep the loan, after year 2, 3, 4, there's no extension fees. So that worked well in our favor. And then essentially we're also planning for another $500,000, like a self-imposed reserve that we want to fill for an additional rate cap if we get to September 24 and the rates are going the opposite direction of what we hoped, right? So we're hoping they all go down. We look at 1 month SOFR, and see it creeping down 2024. You look at forward curves and all that stuff. For those of you who follow, well, if it goes the opposite, we're trying to think about reducing the risk, and that's how we're doing it. We'd think about a 3% strike price or, something like that, another $500,000 easily. And who knows what the price could be then, but essentially let's put some money in it and let's make our own reserves in addition to the interest reserve that the lender required. So the option is for us to keep the loan and keep going, potentially look for other, refinance options or exit. And ultimately we want to mitigate the risk of, rising interest rates. And, that's how we're covering it. So we feel pretty confident, at least about that. No one has a crystal ball, neither do I. There's inherent risk in every deal, right? But we feel like, hey, this is, how we're attacking it and how we underwrote it and decided to get after it. And there it is. So as soon as my slide progresses, anything else while my slide is catching up, Jeremy, on the interest rates? Interest rate cap?
Crystal ball there for sure. Just being able to sleep at night, buying a rate cap in the money. Like you said, it was costly at the time, but thankfully we did close when we did, because today, if I rerun that same strike at that rate, it's about $1.6 million today to purchase the same interest rate hedging instrument. So, things are in hindsight's always 2020, but we just like to, as a prior bridge lender myself for several years, um, seeing this type of rate hike environment, just knowing that we wanted to be protected in case the Fed kept running things up like they did.
Oh, well, this slide deck thing is fun. Trying to get to our exit models, or cap rate assumptions. Oh, here we are. Okay, so essentially right now, what's happening, the data that we're pulling, there's not a ton of transactions, but essentially the latest transactions are the ones that we're looking at for these particular numbers and saying, hey, how does our valuation look? And so average sale price in North Dallas, 2022 to 23, 273K a door. There's some things that make that number nice and fun, new product, class A, that kind of stuff. But I think being in the market and right where we are across from Allen High School, I think we are proving pretty damn competitive as is. The entry cap rate, this is adjusted for taxes. If you're an underwriter, you kind of, looking at your investments in a different way, right? When you buy the deal, you've got to project taxes going up. So you underwrite and say, oh, I'm going to project taxes are going to go up for my new purchase price. So this adjusted for taxes, the cap rate, the last transactions are like 3.55. And so, as close as comps as we can get to, for the slow transactions that are happening. But overall, the point is we're not underwriting at an exit cap of 3.5. They are trading at 3.5 to 4, a little higher. We're thinking, hey, look, in 2024, 2025, if we can just get in this 5 cap range, we're excited. Jeremy, on our original underwriting, our original deal, can you walk us through our exit cap? What was our exit cap rate? How were we thinking about the spread and, between entry and exit?
Yeah, we don't like to hold anything too stagnant, and we like to look at it from a sensitivity table analysis. So if we have it in here, it'll kind of just show you, hey, based on a 4.75% cap rate, which was our original exit, we then modified it to a flat 5% a few months back, and showing still a strong return to the LPs and overall, thinking about, hey, what happens if we need to hold on to this thing longer in case the environment is not fitting. It's nice to have those extension options in our loan provisions. It's just that we would need to make sure we're being prudent and proactive about that rate cap and keeping that in mind while we continue to execute our business plan, because we don't want to be forced to sell in any environment. We want the timing to work out for all of our investors. And so those are a couple different scenarios there.
There you go. Okay, well, if my slide deck decides to work with me on this benefit from depreciation, if you can see that, there is a little bit of depreciation left. I think the biggest benefit last year for our investors, and I'm excited for the 50 million that decided to move forward last year. They got a big equity chunk and a big depreciation chunk. There is some left over. It's probably enough to cover the returns at this point. It's not going to be a 50 or 60% loss by any means, because last year was the big chunk, was the 100% bonus depreciation. This year it drops a little bit, and it's the remainder of the accelerated depreciation that we're taking year 2, 3. So there's some, it's just not going to be massive, but it is still there. It's probably enough to cover returns. So you still need to talk to your CPA, and you need to kind of do all that stuff. So I am going to really quick discuss, the next steps, or just give everyone the link here. In transparency, we put the deal out for our, actually it says webinar attendees, sorry, for our new investors our existing investors. We started this about 3 weeks ago, a month ago, and just saying, hey, this is available. We let them know. For you on the, brand new coming to the opportunity, essentially any dollar that gets invested in from now till the end of June, which is, a quick run, will be August 1st. So the dollars afterwards, there's my slide going. The dollars afterwards will be on the next quarterly distribution. So you want to just, kind of think about that as, hey, the dollars going to get or coming in are going to be distributed quarterly. And from a timing aspect, you don't have to worry about the time crunch to try to get in by June. It's essentially $5 million that we've already invested in the deal. It's a preferred equity. Once it's filled and full, that's the actual deadline. So what I'm going to do is put this link into our chat so that anybody's seeing it. I'm going to try to get off this dang screen show because this did not work out well for me. Let's see, end slideshow. Okay. And in our chat here, I'm going to put the link for everyone. I'm going to give everyone some time for questions as well. But that link, if you want to go, place your commitment. We started, putting it out there. $5 million is roughly $1 million-ish. That's pretty interested at this point. Funding wise, it's starting to roll in. I wouldn't say it's probably going to be the most immediate $5 million equity raise. I think it'll come just slowly and steadily as people come from now till the end of the year. Everyone's looking for deals. There's been very little transactions. 12% pref is unique. I haven't seen it at all, since 2020 and COVID when I did it. I've done a 12% preferred equity deal at the beginning of COVID. We closed the deal actually in Dallas, the Summer Wind deal. And that deal did exactly what I was supposed to do. It returned 12% fixed. There was no upside, but it was a good deal for that time. People were a little uncertain. So I think, now kind of mimics that. It came in slow and steadily, $4 million raise, and it was a good, 12% fixed. So this is going to be the same. So that link is there. If you guys want to move forward, you have the ability to, invest now. You will see other options in this original investment portal, because it originally did come out Class A, Class C. If anybody is thinking about the upside and you want the upside, essentially we still have Class A, Class C. You have multiple options in the deal. If you want just upside and a 7% pref, that's still available. If you want 12% fixed, that's also available. But, more one-on-one conversation depending on everybody's investment goals. So that will be there. And I'll just leave it on this as we kind of go to any questions here. So let's see. Q&A, anyone? Let's see here. And feel free, use the, chat or the Q&A bar. Let me bring this up. Okay.
I got to use this workout facility while I was there. It was open 24/7, ran into some other tenants, and it was nice. I really enjoyed my time. My first time actually like getting out to Dallas for more than just a week. It's usually a few days, get there, due diligence, leave. So I'm like, let me go spend some time with the on-sites. Really, we talk to them every day. But to be there in person, interact with the community, we hold events monthly, sometimes even twice a month. It's a nice, really nice community vibe, and it's important. It goes a long way with the retention. We're seeing a good rate of renewals overall, and it's more of a really sound neighborhood just due to the fact that there's very low crime, great schools. So hopefully that does show through. I know it's hard to get all of that feeling from some photos, but when you're there, you really do feel it.
Also, I don't think we talked about the Amazon package delivery kind of thing too. So, in the newer, modern Class A builds, package facility type of thing. So this is the package area. It looks really, super clean, right next to the mailboxes. Came out really well. Okay, so question. Are you raising more capital than originally anticipated? No, we're not raising additional funds. We intended on a $20 million equity raise. We raised 15. It was supposed to be preferred equity, and they were going to put in a $10 million check. It didn't come. So we raised 15 out of 20 during a rough year last year. And the other 5, essentially, our general partners put some money in, and now we're going back to offer the preferred equity, the original plan. So it's not a dilution. It's essentially the original money, but instead of giving away control to a pref equity shop, when they're actually, now they're looking for deals, and we're kind of saying, we're maybe not give away control of it. So this is how we did it. If there's a current investor, I can see this question as well. Current investment in 301 Greenville, you continue to earn, blah, blah, blah. This new class. Okay, so this does not affect your current investment. It's still the original Class A LP spot. The preferred equity is in front of the Class A at return, but it is a 6% cash flow paid out deal. The 6% remaining to total 12% pref equity does come out first, and then everything after is the why we have upside. You're taking additional risk on the lower pref, but getting the upside. The fixed 12 gets fixed 12, no upside at all. So we don't expect like a dilution or watering down of investment. I guess as close as you could come to it is say we're going to have to get an extra $1 million of valuation to pull that out, but along the lines of it was originally planned. Additionally, there's an opportunity we may not need the full 20, which will work really well instead of maybe 18 or 19 million, depending on how everything turns out. So that would be good. And difference between investment and a dividend paying stock. So that's a good question. Stock market is currently, I mean, if you're in the stock, it's going to be a little crazy. A lot of dips and valleys. Over 100 years, I heard the average is about 8% annual return. We're doing 6 current, but then there's the 6 at the end. So 12%. I think it'll fare pretty well versus a dividend in the stock market. The investment period, we plan to refinance. Call this or refinance or exit. Call it a 1 to 3 year deal. Opportunity maybe in a year from now to exit or refinance, and we would pay back the preferred equity, or maybe it's a little longer. Maybe there's 2 to 3 years. And that's kind of why we're saying 1 to 3, depending on how the deal goes. Funding it began immediately. We already offered this to the existing investors. Let's see. And how are we? This is a good question. How are we doing against our current underwriting performance assumptions? And currently we're getting $220 rent increases. I kind of went over that. 40% rent growth on renovated units, 20% on the lease trade outs, 10% on renewals. Over the last 8 to 10 months, our NOI is pretty similar right now to when we closed it. However, we're going through a lot of the bottom out, if you want to call it that. On most value adds, you're trying to remove some tenants or non-renew if they don't have the higher enough premium. And so we've got 15% higher economic vacancy to the units that are offline right now when we're renovating them. So once we put those back online at the $200 plus premium rents, or the $375 gap that we're trying to get per unit, $500-600 per rent per unit, that's what we're gonna hum. So we're excited for that. And that's unless anybody else had any questions. Jeremy, anything you think I missed?
No, you did a great job, Abel. Just here to kind of help with any of those supporting numbers.
Right on. Well, if anybody else has any NOI questions, number questions, whatever, Jeremy's here. Afterwards, you can email me. You can let me know if you're interested. If you want to put a commitment directly into the portal, you have the link. I'll send this out to everybody that was attending and registered. We appreciate it. And thanks for your support as always. We look forward to it and look forward to the next investment opportunity. Thank you.
Thank you, guys.